A more normal week ahead, and hopefully we can focus on economic data. Hopefully we can expect a quieter week this week with regards to news from the White House, and that's allowing us to focus in on economic data. In morning markets today, of course, we're going to focus in on US jobs data, given it is the end of the month. On Friday, we can expect the US payrolls data for April. It's expected to show some cooling, but there may be some early signs of bigger weakness if US corporates have really dialed back in their hiring intentions. The Federal Reserve will, of course, be focused on this jobs print, given that they are holding rates steady, but their bias is towards further easing. They'll also be looking at the quarterly wage data, the ECI, the Employment Cost Index, which is their preferred measure of wage growth. That has cooled substantially over the last 2 years, from just above 5% to below 4%. If there is any further cooling in wages, then expect the Federal Reserve probably to be ready to cut rates towards the end of this quarter. But the print which is most likely to dominate this week is going to be Q1 GDP from the US. That's published on Wednesday. Now, since the inflation boom, the US has been enjoying a bit of a growth surge. Growth has been substantially above trend for over 8 quarters, closer to 3% than 2.5%. There was some modest cooling in Q4 last year, in the last quarter of President Biden's term, but we are likely to see some substantial effects already from the threat of tariffs from Donald Trump. When Donald Trump was elected, US importers substantially raised their order books and tried to front-run tariffs. That is, there was a surge in imports from international markets into the US. The measurement effect of this is it actually subtracts from US GDP. So we're likely to see some weakness in Q1 from the US, such that annualised growth declined from around about 2.5%, perhaps as low as 0.5% as is market consensus. That's a substantial cooling, and it's all really to do with tariffs. But we may also see some weakness come through from those DOGE cuts across the federal government, and also the wider malaise from tariffs. If there are to be any other distractions in markets this week, it's likely to come from European inflation, particularly the Eurozone. Recall that the ECB, the European Central Bank, has been able to cut interest rates the most over the last 18 months because inflation there didn't rise as much as, say, the US or in the UK and has declined more. Core inflation is at 2.4% and the ECB has a target of 2%, so it's tantalisingly close. Should inflation decline again for the month of April, then expect the ECB ready to cut interest rates in June. So it's good news this week, and of course we remain in a cutting cycle from global central banks. Please join us through the week as we'll update you on data from the US. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.